Think of market liquidity like gravitational mass. Large entities do not exist in a vacuum. They naturally attract and consume smaller pools of capital to sustain their own momentum. Price action in high-volume crypto markets is not a random walk, and it is certainly not driven by retail sentiment. It is deterministic. The movement is driven entirely by the mechanical requirement of the order book, where massive institutional entities must fill huge orders without triggering extreme price slippage. To execute trades of that size, the market actively hunts leverage to find necessary resting liquidity. We can observe exactly how this mechanism operates by tracking a 6-day window of Bitcoin data from July 29th to August 3rd. This liquidation heat map measures where leveraged positions cluster across the price scale. Look at the center right, where a massive red price candle plunges into the thickest bright yellow band. That sharp downward movement is intentional, perfectly targeting the brightest concentration of heat. Tracking these leverage clusters reveals the specific price levels where the market finds the liquidity necessary to facilitate large-scale trades. We begin the timeline on July 29th. The market is in a baseline state, with price ranging tightly near the $64,000 level. Look directly below that current price action. You can see dense bands forming between $63,000 and $64,000. Mathematically, these bright yellow bands represent massive clusters of over-leveraged long positions. Retail traders are making a predictable tactical error. They are placing their liquidation triggers directly below what they perceive as structural support. Advancing the timeline 24 hours to the evening of July 30th, we see those leverage bands intensifying. Continuous flat ranging behavior builds a false sense of security, encouraging even more market participants to leverage long. For a market maker, this yellow zone is not an abstract metric. It is a guaranteed pool of automated, forced sell orders just waiting for a trigger. If a massive institutional entity attempts to accumulate a long position in a thin order book, they face a logistical nightmare. Standard limit orders cannot absorb institutional size without rocketing the price upward. That makes this resting counterparty yellow liquidity mathematically essential to fill their orders. The growing yellow band below the price does not act as a cushion. It acts as an irresistible magnetic force, dragging the price downward. On August 1st, that magnetic pull mathematically overcomes the resting price. Retail traders often narrate this kind of drop as panic selling. In reality, this initial downward break is a highly targeted institutional hunt for liquidity. By midday, the price candle deeply penetrates the thickest concentration of the yellow band. Breaching this specific level triggers a cascading mechanical reality. Thousands of overlapping margin calls fire simultaneously. This forces the automated market selling of liquidated retail longs, which is then cleanly absorbed by institutional limit buy orders resting quietly in the dark. It is an immediate transfer of wealth. Moving to the end of August 1st, we can observe the immediate structural aftermath of the sweep. The visual feedback is stark. The bright yellow band has been entirely vaporized, leaving a dark purple vacuum behind. With those stops hit and liquidity consumed, the downward fuel driving the market is completely spent. Rapid descents into these liquidity bands mechanically rebalance the market to sustain a functioning order book. By August 2nd, the market microstructure begins to rebuild immediately following the liquidity vacuum. Looking at the dark, empty space below the new price level, we confirm a total lack of downside gravity. Having just watched a rapid crash, retail traders react tactically. They begin heavily shorting the bottom of the move. Transitioning to August 3rd, the architectural result of that retail behavior locks into place. Massive, bright yellow clusters are now aggressively forming above the price. This new zone is a dense concentration of over-leveraged short positions with unprotected buy-to-cover liquidation triggers. In the span of 48 hours, the primary pool of resting counterparty liquidation triggers completely flipped sides. The order book is now entirely asymmetric, mathematically priming the market for a violent upward sweep to consume the newly minted shorts. Compare the initial state of heavy long buildup on the left to the post-sweep reset of heavy short buildup on the right. This cycle of buildup, sweep, and reset provides a mechanical explanation for how short-term volatility is generated and exhausted. Relying solely on historical price action or moving averages creates a permanently lagging, reactive trading strategy. Mapping leverage concentration provides a leading, predictive model of market mechanics. By identifying exactly where over-leveraged participants cluster, analysts can map the price levels of upcoming, highly probable market sweeps before they occur. Ultimately, the location of resting liquidity determines the path of least resistance for price.